All right, let's dive right into this explainer of LexinFintech's Q1 2026 earnings. We've got a really fascinating tug of war happening within their financials right now. On one side, explosive top-line growth, but on the other, a very deliberate strategic bottom-line contraction. It's basically a classic balance sheet seesaw, And figuring out how it works tells us a whole lot about the current state of consumer finance in a pretty shifting economy.
So here's our roadmap for today. 1. Growth despite macro headwinds. 2. The e-commerce catalyst. 3. Risk management and profitability. And 4. The outlook for the future. Let's get to it.
Starting off with Section 1, Growth Despite Macro Headwinds, or as I like to call it, the Q1 2026 top-line triumph.
Look, the sheer scale of their reach is just undeniable at this point. Total registered users across the Lexin platform hit a staggering 250 million this quarter. 250 million! To put that into perspective, we're looking at a super solid 7.6% year-over-year increase. They aren't just sitting back and holding on to users, they are aggressively expanding their footprint.
And those users, they definitely aren't just sitting idle. They're incredibly active. All that activity drove total loan originations to an impressive 57.9 billion RMB in the first quarter alone. That's a sequential jump of almost 16% right from the previous quarter. Generating nearly 58 billion in a single quarter, that shows some massive underlying consumer demand.
Now, Chief Financial Officer James Zheng brings up a really fascinating concept regarding all this, a structural buffer. He notes that while the broader macro environment and some strategic shifts did moderate their traditional growth, their expanding business ecosystem actually provided this buffer. It's a great metaphor, really. They aren't just relying on one single engine to pull the whole train. Their diversified operations are acting as a real shield against market volatility.
And the numbers brilliantly illustrate that structural buffer in action. Literally half, 50% of their total loan origination is now coming from non-consumer finance avenues. We're talking about areas like installment e-commerce, offline inclusive financing, and fintech empowerment services. They've essentially split their risk and their revenue generation right down the middle.
Which brings us to Section 2, the e-commerce catalyst. Let's see what's driving that non-consumer mix.
The absolute standout metric here is a massive 95% year-over-year surge in gross merchandise volume, or GMV, for their installment e-commerce platform. They hit 2.2 billion RMB and served over 600,000 users in this segment alone. I mean, when you see a 95% jump in a specific business line, you know for sure you found the engine driving that structural buffer we were just talking about. So this e-commerce catalyst, combined with all that user growth, pushed their total operating revenue up by 6.6% to 3.3 billion RMB for the quarter. On the surface, everything looks incredibly green. But here's where our narrative pivots, and that balance sheet seesaw really tips, because we have to ask, what about the bottom line?
Well, despite total revenue climbing, net income actually plummeted by 53.2% year-over-year. It dropped from 430 million RMB all the way down to 201 million. Seeing revenue go up while profit gets slashed in half? That begs a massive question. What exactly is dragging down their profitability?
That leads us right into Section 3, Risk Management and Profitability. Let's solve this mystery.
If we demystify these operating costs, we find the heavy anchor weighing down that net income. It's massive jumps in provisioning. The provision for financing receivables nearly doubled, jumping from 182 million to 341 million RMB. But the real heavyweight here? That's the provision for contingent guarantee liabilities, which surged from 677 million to nearly touching 1 billion RMB in a single quarter.
Okay, let's make sure we're totally clear on what that term actually means. Translating this data into business reality, a provision for contingent guarantee liabilities means Lexin is deliberately setting aside a huge cash safety net. As they increase off-balance sheet loans funded by their institutional partners, they're required to hold more in reserve. So essentially, they are trading short-term explosive profits to build this financial fortress, really, against potential future defaults and ongoing economic uncertainty.
But you're probably wondering, are those defaults actually happening right now? Well, grounding this risk in actual credit performance, their first payment default rate, which basically tracks customers failing to make their very first payment, is holding incredibly steady. As of March 31st, it was tracking right below 1%. So these massive provisions aren't necessarily because the loans are currently going bad. It's a proactive, highly protective measure on their part. And you can actually track this protective strategy over time by looking at how different groups of loans perform over their lifespans. Lexin is actively flattening the curve on loan defaults across different timeframes. They're optimizing their product matrix to keep a very, very tight, controlled grip on risk.
Finally, let's wrap things up with Section 4, Outlook for the Future, and how they're positioning for Q2 2026.
Management is taking a distinctly prudent path forward here. For Q2 2026, they're anticipating relatively flat loan originations. Instead of just chasing pure volume, they are heavily investing in their ecosystem, user engagement, and really upgrading their customer service infrastructure. They want steady progress across market cycles, heavily prioritizing what they call high-quality sustainable growth over rapid, riskier expansion.
Which leaves us with this final, absolutely critical question as we close out today's explainer. Has Lexin built a strong enough structural buffer with its e-commerce expansion and massive cash reserves to genuinely ride out the storm? Or will the persistent macroeconomic uncertainties ultimately break the seesaw, forcing them to choose between growth and profitability? It's a delicate balancing act, for sure, and one that makes Lexin a fascinating company to watch in the coming quarters. Thank you so much for diving into this with me, and keep questioning the data.